Welcome to Griffonomics. So I want you to imagine a scenario, right? A rogue AI agent breaches your company's network. But it doesn't, sit there typing on a keyboard. It's not slowly clicking through folders trying to guess passwords.
Right, because in the time it takes you to blink, that autonomous agent has already executed like 10,000 malicious commands.
Exactly. It's completely rewritten your cloud infrastructure, and it's siphoned your proprietary data right out the back door. So today, we are opening up a brand new deep dive into a massive stack of financial reports, earnings call transcripts, and market analyses focused entirely on Zscaler.
And it's a fascinating stack of documents, really.
Oh, absolutely. Because our mission today is to build a granular investigative report on how this company is fundamentally transforming. I mean, they're evolving from what used to be a pretty straightforward remote user security tool into this massive AI-powered, zero-trust everywhere platform.
Which is a massive leap.
Huge leap. And whether you are evaluating a tech portfolio right now, or you're a business leader just trying to, wrap your head around the future of enterprise AI, figuring out how these autonomous AI agents are actually secured it's the critical missing puzzle piece that nobody's really talking about.
No, they aren't. We spend so much time marveling at the generative capabilities of AI, right? Like writing code, drafting emails, negotiating contracts. But we spend very little time analyzing the invisible plumbing required to keep those same autonomous programs from unintentionally or maliciously dismantling an enterprise from the inside out.
Right.
The infrastructure required for that level of security is it's fundamentally different from anything we've built over the last 20 years.
Okay, so before we can even touch the financial numbers or try to decode why Wall Street had a mild panic attack over their recent earnings, we have to look under the hood at that exact infrastructure.
Yeah, you have to understand the architecture first.
Exactly. We have to understand what Zscaler actually does differently from legacy security and how their revenue engine is actually built, because the architecture dictates everything else.
Right. Completely.
So think of legacy firewalls like a medieval castle with a moat. You've got the drawbridge, you have the heavily armed guards at the gate. But once an attacker, whether human or a piece of software, crosses that moat and gets inside the castle walls, they are inherently trusted.
Right, they can just roam the halls freely.
Exactly. They wander from the kitchen to the armory to the throne room. But Zscaler is more like a high-security hotel. Your key card only opens your specific room and, say, the ice machine down the hall.
And nothing else.
Nothing else. But it actually goes further than that. It's a hotel where the security guard physically checks your ID and your key card every single time you reach for a new ice cube. Continuous verification.
That's a great way to put it. In technical terms, that medieval castle represents what we call a pass-through architecture. It connects users to a broad network and just trusts them by default once they bypass the perimeter.
Which is terrifying in the AI era.
Oh, absolutely terrifying. So Zscaler operates what they call the Zero Trust Exchange. It absolutely does not act like a bridge into a network. It functions as an incredibly strict, intelligent switchboard.
A switchboard.
Right. It creates secure, temporary, one-to-one connections based on rigid policies. The user or the software agent never actually connects to the underlying network itself. They only ever connect to the specific application they are explicitly authorized to use at that exact moment.
Wow. So they eliminate that lateral movement entirely.
Exactly. Eliminating that lateral threat movement, the ability to roam those castle halls, is the foundational requirement for securing a modern, decentralized business. If malware infects a single laptop in a coffee shop, the switchboard prevents it from seeing, let alone infecting the rest of the company.
And what's wild is they are taking this core switchboard model and drastically expanding its footprint. The sources we're looking at outline 3 growth pillars for Zscaler.
Right, the first one being zero trust everywhere.
Right, which means taking that high-security hotel keycard concept and applying it not just to remote human users, but to physical branch offices, factory floors, and these massive cloud workloads.
And the second pillar is data security everywhere. That focuses on automatically identifying and protecting sensitive data, literally no matter where it lives.
And then the third pillar, which we'll spend a lot of time on, is AI security. Now, all of this expansion relies on a pretty established revenue infrastructure. They operate a software-as-a-service model that is 98% subscription-based.
That's a massive base of recurring revenue.
It is. But the metric that really stands out to me in these reports is that 84% of their revenue is driven by channel partners. They rely heavily on third-party global system integrators to actually sell and implement this tech.
Well, that intense reliance on channel partners is really a direct reflection of the architecture we just discussed. I mean, moving a massive Fortune 500 enterprise from a legacy network full of firewalls to a pure zero-trust switchboard architecture, it isn't just a simple software update.
It's not just a patch you download.
No, not at all. It requires tearing down the old medieval castle and building that high-security hotel entirely from scratch. It is a massive architectural redesign. So Zscaler provides the blueprints and the materials, but they need those massive global system integrators to actually manage the construction project for the client.
Okay, so that structural setup brings us to their recent Q2 2026 results.
Yeah.
Because this superior architecture drove what looks, on paper at least, like an absolute blowout quarter. Yet Wall Street still hit the panic button and sent shares tumbling about 9%.
Yeah, there was a real disconnect there.
A massive disconnect. We have to unpack this difference between the elite headline numbers and the market's visceral reaction. Let's look at the top-line metrics first. They hit $816 million in quarterly revenue.
Which represents 26% year-over-year growth.
Exactly. And in the first half of the year, they generated a staggering 36% free cash flow margin. They're operating at what analysts call a rule of 62.
Which is incredible. For anyone unfamiliar with that metric, you just take the revenue growth rate, add the free cash flow margin, and that gives you your score.
Right. And the gold standard for elite, highly profitable SaaS companies is usually the rule of 40.
Yeah, 40 is considered excellent.
But Zscaler hit 62. They completely shattered the benchmark. And they even raised their full-year revenue guidance to over $3.3 billion.
So the headline numbers clearly demonstrate a highly efficient cash-generating machine. But, Wall Street does not value software companies based purely on present-day cash. They value them based on forward-looking growth momentum.
Right, the future expectations.
Exactly. And when analysts dug into the supplemental financials, they found a perceived crack in the armor. This is what the financial community is currently calling the organic debate.
The organic debate. Okay, so the core of this debate centers on annual recurring revenue, or ARR. The total net new ARR they brought in for the quarter was $156 million.
But there's a catch there.
Yeah, the catch is that Zscaler recently acquired a cybersecurity company called Red Canary, and Red Canary exited Q2 with $114 million in ARR of its own. So if you strip out the contribution from that acquisition, Zscaler's organic net new ARR was only $139 million, which translates to just a 7% year-over-year growth for their core organic business.
And because of that specific math, their total organic ARR growth decelerated from 22% in the previous quarter to 21% this quarter.
But wait, aren't investors just completely missing the forest for the trees here? I mean, hyper-focusing on a tiny 1% dip in organic growth while a company is operating a massive cash machine at a rule of 62, that feels like a massive overreaction to me.
Well, the tension here is really a classic study in SaaS market psychology. I mean, I see your point, but Wall Street's fear stems from the historical precedent that organic deceleration is often the earliest warning sign of market saturation.
Oh, or like pricing pressure, right?
Exactly. Pricing pressure or increased competition. Investors willingly pay a premium multiple for organic growth because it proves the core product is still flying off the shelves. They generally do not want to pay a premium for purchase growth through acquisitions.
That makes sense.
However, the Rule of 62 metric is precisely why long-term analysts view this sell-off as short-sighted. I mean, generating a 36% free cash flow margin creates an incredibly robust financial safety net.
Right, because it gives them options.
Exactly. It allows Zscaler's management to fund aggressive research, execute strategic acquisitions, and weather macroeconomic slowdowns using their own cash. They don't have to dilute shareholders by issuing new stock, and they don't have to take on crippling debt at high interest rates just to keep the lights on.
Which is a huge advantage right now. And frankly, while the market throws a tantrum over a 1% deceleration, Zscaler's management is entirely focused on what they clearly view as the most significant catalyst in the last 2 decades.
Securing the AI era.
Yes, securing the AI era. Because the data in these reports regarding AI threats, it's highly alarming. AI weaponized attacks have surged 156% globally.
It's why
attackers are utilizing generative AI to write polymorphic malware, which is basically code that constantly rewrites itself on the fly to evade traditional signature-based detection. And this is happening as enterprises are simultaneously rushing to lock down internal systems against future quantum computing threats.
This is exactly the battlefield for their third growth pillar, AI security. And they're approaching this from two distinct angles. The first is securing the AI applications themselves through innovations like AI Protect and their SPLX integration.
Tell me more about SPLX.
So SPLX essentially provides automated red teaming. Instead of hiring humans to try and hack your system, you deploy AI models to constantly attack your own AI infrastructure, probing for vulnerabilities before malicious actors find them.
That's brilliant.
It is. And crucially, they also enforce dynamic runtime guardrails. These are strict policies designed specifically to block sensitive enterprise data from being exported into public large language models.
Okay, so if an employee in the finance department decides they want a public AI chatbot to quickly format a spreadsheet, and they accidentally paste the company's entire unreleased quarterly earnings report into the prompt.
Which happens more than you'd think.
I bet. So the runtime guardrails intercept and block that data transfer before it ever leaves the corporate environment.
Precisely. It protects the company from its own well-intentioned workforce. But the second angle of their AI strategy is far more critical to their valuation. That's Agentic CCOP.
Agentic CCOPs. Right?
Zscaler is actively integrating Red Canary's AI threat detection capabilities directly into its own proprietary data lake. And to understand the scale of this, you have to realize Zscaler processes an astonishing 500 billion network transactions every single day.
500 billion a day.
A day. That is petabytes of data flowing through their global switchboard. So they are taking that unprecedented volume of telemetry data and using it to train AI models that can fully automate a traditional security operations center.
Okay, so the concept of AI agents is everywhere right now, but the actual monetization mechanics are rarely explained. How does a company actually charge money for securing a piece of software that is just talking to another piece of software?
It's a great question.
I mean, charging a subscription fee for a human employee logging into an email server, that's straightforward. But applying that business model to autonomous machine traffic feels incredibly complex.
Right. Well, you really have to look at the velocity and volume of the threat to understand the monetization. AI agents are not passive chatbots waiting for a prompt. They are autonomous programs granted the authority to take actions across a cloud network.
Okay.
So if a threat actor hijacks a human employee's credentials, that human operates at human speed. They click around, they run a search query, they maybe try to download a sensitive PDF.
It takes time.
Exactly. But if a threat actor hijacks an AI agent, that software can execute tens of thousands of malicious commands, exfiltrate entire databases, and alter foundational cloud infrastructure in milliseconds. Yeah, a compromised AI agent is exponentially more dangerous than a compromised human. And because of that extreme risk, inline, massive-scale policy enforcement is mandatory, not optional.
So how do they charge for it?
Zscaler monetizes this by positioning their zero trust exchange directly in the path of all machine-to-machine traffic. If an AI agent wants to query a database, it has to pass through the Zscaler toll booth first, and Zscaler charges based on the volume of that automated traffic.
Okay, building a toll booth capable of inspecting AI traffic at millisecond speeds that requires highly specialized technology, which completely explains their recent shopping spree.
Oh, absolutely.
Zscaler hasn't just tried to build this entire AI security fortress from scratch. They've executed highly targeted M&A mergers and acquisitions to assemble the necessary pieces. We already touched on Red Canary, which cost them $651 million.
Right.
But what's interesting in the earnings transcripts is that management was surprisingly transparent that post-acquisition churn has been elevated for Red Canary's legacy business.
It has been, yeah.
Apparently, high customer turnover is pretty standard for managed detection and response businesses operating in smaller commercial segments. Smaller companies tend to switch security providers frequently based on price. Yet, Zscaler views this acquisition as the absolute linchpin for their agentic CCOP strategy.
Well, that's because they are entirely unconcerned with the smaller commercial customers churning out. They bought Red Canary for the underlying detection engine, not the legacy customer base.
Oh, interesting.
Yeah, they intend to apply that detection engine to their massive Fortune 500 enterprise clients. And the same deliberate strategy applies to their $113 million acquisition of SquareX.
SquareX, right? The browser security company.
Yes. This purchase was designed to completely redefine browser security. Large enterprises face a massive vulnerability with BYOD, bring your own device.
Which is everywhere now.
Everywhere. When a contractor logs in from a personal, unmanaged laptop, the traditional security solution is to force them into a slow, clunky virtual desktop environment or make them download a heavy, restricted enterprise browser that just ruins the user experience.
Nobody likes those.
Nobody. So SquareX bypasses all of that. It uses highly sophisticated, lightweight extensions that secure standard consumer browsers like Chrome or Edge. It isolates malicious files within the browser itself, providing uncompromising enterprise security without adding any friction for the user.
And then they also acquired a company called Avalor, right?
Yes, Avalor.
Which provides the underlying data fabric required to actually organize those 500 billion daily transactions and petabytes of AI logs. So when you look at this string of purchases, Red Canary, SquareX, Avalor, you kind of have to wonder, are they just buying revenue to mask that 1% organic deceleration? Or is this like a Voltron situation where these separate acquired pieces genuinely assemble into a unified platform that's significantly more powerful than the sum of its parts?
It's definitely a Voltron strategy. The technology architecture strongly indicates a unified platform. I mean, enterprise software is littered with Frankenstein tech stacks where a giant company buys a smaller competitor, slaps their corporate logo on the dashboard, and just leaves the underlying code completely disconnected.
Yeah, right. Which creates a total nightmare for the customer.
Exactly. But Zscaler is executing tuck-in acquisitions. These technologies are being fundamentally rewritten to be native to the Zero Trust Exchange. Just consider the data flow.
Okay.
Avalor provides the foundational fabric to organize the massive data lake. Red Canary sits on top of that fabric, providing the AI engine to detect anomalies within the data. And SquareX secures the extreme edge of the network where the user actually interacts with the data.
So they all fit together.
Perfectly. They are strategically buying specific architectural capabilities because building them natively would take years, and the AI threat landscape is evolving in months.
Right. But assembling the ultimate AI security platform is an engineering marvel? Sure. But it's completely useless if a stubborn enterprise chief financial officer refuses to approve the purchase order.
That is always the hurdle.
Always. Selling a massive multi-module tech stack to procurement teams is notoriously difficult. Which brings us to a massive strategic inflection point in how Zscaler is evolving its business model.
The pricing evolution.
Exactly. They're actively shifting away from their traditional seat-based pricing model, where a company pays a flat fee per human employee, and they're moving aggressively toward non-seat-based metered usage pricing.
Which is huge.
It is. They're now charging based on the volume of IoT device traffic, cloud workload interactions, and the number of AI tokens processed. The financial reports show this metered pricing model now delivers over 25% of their new annual contract value, or ACV. And that specific revenue segment is growing at over 100% year over year.
And to accelerate that transition, they've rolled out a new procurement framework called the ZFlex Catalyst.
ZFlex, right.
Yeah, because enterprise software procurement is traditionally a rigid, agonizing process. A company might sign a massive 3-year contract for a specific data security module, but in year 2, their business needs change, and they realize they actually need an AI protection module instead.
And historically, that requires initiating a brand new, months-long procurement cycle, demanding more budget from the CFO.
Exactly. It's a nightmare. The ZFlex program eliminates that friction. It allows a customer to make a multi-year financial commitment upfront, total contract value, or TCV, but it gives the IT department the flexibility to dynamically swap modules on the fly without ever returning to the procurement desk.
That's incredibly smart.
It's working, too. In Q2 alone, this flexible ZFlex model generated over $290 million in total contract value. That is a 65% increase just from the previous quarter.
Wow. Okay. The appeal for an IT director is obvious. They get agility without the bureaucratic headache. But, from an investor standpoint, shifting to metered pricing based on fluctuating data volume and AI tokens seems incredibly risky.
Why do you say that?
Well, doesn't abandoning the reliable one subscription per employee per year model make Zscaler's future revenue deeply unpredictable?
I mean, it introduces a slight degree of short-term variability, sure, but strategically, it is a masterstroke. Think about the trajectory of enterprise computing. As autonomous AI agents proliferate across every department, finance, HR, supply chain, software development, the sheer volume of machine-to-machine traffic is going to absolutely dwarf human traffic.
Well, that's true.
Right. A global enterprise might employ 50,000 humans. That represents a hard ceiling for seat-based licenses. But that same enterprise could deploy 2 million autonomous AI agents that continuously ping servers, generate logs, and query databases 24 hours a day, 7 days a week.
Oh, wow. So it's a completely different scale.
Exactly. By shifting to metered usage pricing right now, Zscaler is permanently attaching its revenue model to the exponential growth curve of enterprise AI computing. If they stubbornly clung to seat-based pricing, they would completely fail to monetize the largest explosion of network traffic in internet history.
They're essentially ensuring that as their clients get more advanced, Zscaler automatically gets paid more. It sounds like an unstoppable growth engine. But, every machine operates in the physical world, and these reports highlight several real-world risks that threaten this trajectory.
Yeah, we have to look at the risks.
We've already explored the market skepticism surrounding that 21% organic deceleration fear. But the operational risks are what I find really fascinating,
Right.
particularly the supply chain pressure.
The hardware side.
Yeah. Zscaler management is actively monitoring the rising costs of physical memory or computer processors, noting that inflation here could impact their data center capital expenditures and threaten their target of maintaining an 80% gross margin.
Right.
But wait, why does a pure cloud software company care so deeply about the physical cost of silicon memory chips? Are they secretly operating a massive hardware business in disguise?
It's a common misconception, right? The concept of the cloud often misleads people into thinking of magic, invisible software floating in the ether.
Right.
But the cloud is just someone else's massive air-conditioned warehouse full of physical computers. For an email provider, relying on public cloud infrastructure like Amazon Web Services or Google Cloud is fine. But Zscaler operates in line.
Meaning what exactly?
Meaning every time an employee or an AI agent tries to access an application, that traffic must physically route through Zscaler's switchboard. To process 500 billion transactions a day without introducing latency lag that would cripple an enterprise network and drive users crazy, they cannot rely on rented public cloud space.
Oh, so they have to own it.
They must physically own, build, and operate their own purpose-built server infrastructure across more than 160 global data centers. That proprietary hardware is the only way they can guarantee 99.999% reliability.
Wow, so they really are tethered to the physical world.
Completely. They are heavily tethered to the brutal realities of the global silicon supply chain. When hardware components get expensive, Zscaler's capital expenditures spike, directly impacting their gross margins.
That makes total sense. Now, the other major operational risk highlighted in the analyses revolves around data sovereignty. This is that constant agonizing tension between an enterprise wanting blazing fast global cloud performance and governments enforcing strict local data residency laws.
Yeah, the regulatory nightmare.
Exactly. If you are operating a multinational company, how does a global security switchboard handle sensitive data that legally under regulations like GDPR in Europe or DoD IL-5 for the U.S. military is absolutely not permitted to cross a national border?
It requires a highly complex architectural solution, which actually happens to be one of Zscaler's strongest competitive moats.
Really? How so?
Well, most legacy security vendors mush their network operations together. But Zscaler operates a strictly decentralized architecture that separates three distinct elements: the control plane, the data plane, and the logging plane.
Okay, so breaking those apart.
Right, because these are decoupled, Zscaler can route the management commands and policy updates globally to ensure speed and consistency on the control plane.
But the actual data?
The actual encrypted data payloads and the forensic logs of user activity are decrypted, inspected, and stored entirely within localized, jurisdictionally approved data centers.
Oh, wow. So it never leaves the region.
Exactly. The sensitive payload never physically leaves its required geographic boundary. That perfectly satisfies regulators while maintaining global network performance.
That is a massive advantage. So when you zoom out and weigh these physical realities, the organic growth fluctuations, the volatile cost of silicon chips, the labyrinth of international data regulations, when you weigh all that against their massive technological moat and the undeniable tailwinds of the AI revolution, what is the final verdict from the financial analyst community?
The strategic outlook from institutional analysts remains highly optimistic, despite the short-term market turbulence. Wells Fargo, for instance, recently initiated coverage on Zscaler with an overweight rating and set a $200 price target.
That's a strong endorsement.
It is. And the foundational thesis driving that BUY rating is the massive upsell runaway hidden within their existing customer base. Analysts project a 2x to 3x uplift in annual recurring revenue simply by convincing their current clients to transition from the basic users-only security tier to the comprehensive Zero Trust Everywhere suite.
Which is exactly what we were talking about with the Z-Flex program.
Exactly. Furthermore, out of the 20,000 largest global enterprises, companies operating with over 1,500 employees, Only about 4,400 are currently secured by Zscaler.
Oh, wow.
Yeah, that leaves a massive untapped greenfield opportunity.
It sounds like they have spent the last 10 years painstakingly laying down the secure, highly regulated plumbing for the modern internet. And now, just as the volume of traffic is set to absolutely explode, they are realizing they can charge a metered toll for every single drop of AI water that flows through those pipes.
That captures the core re-rating opportunity perfectly. The investment thesis is entirely about recognizing a fundamental paradigm shift. They are evolving from a company that protects humans from the dangers of the internet into a platform that protects the enterprise from the speed and autonomy of machines.
That's a massive shift in scale.
Huge! That shift from human-centric security to AI agent-centric security fundamentally expands Zscaler's total addressable market in ways that the traditional seat-based cybersecurity industry has not fully priced into the stock yet.
It is a profound shift in how we think about enterprise architecture. And that brings us right back to you. As you look at the infrastructure of your own organization or analyze the technology companies sitting in your investment portfolio, consider how they are actually preparing to secure their upcoming AI initiatives.
It's the big question right now.
It really is.
Mm.
Are they still relying on a medieval castle architecture in a world rapidly populating with teleporting AI agents? As autonomous software begins negotiating contracts, processing financial transactions, and rewriting foundational code with other machines at the speed of light across global networks, will security platforms like Zscaler cease to be viewed merely as IT tools and instead become the de facto digital regulatory layer of the entire global economy? Something to think about. Risk defined, portfolio protected,